The purpose of this video is to explain the rules for testing property, plant, equipment for impairments. And it's a two-step process for testing your property, plant, equipment. And the idea or this concept of impairments or testing for impairments, it's really more broad than just under property, plant, equipment. As an accountant, we are testing all of our assets really for impairments, and there's different rules depending on what type of asset it is or whether it's an investment or things of that nature. But this impairment idea goes back to conservatism, and under US GAAP we are always very watchful that we don't overstate our assets, right? So the impairment tests are just part of that thought process of avoiding the potential to overstate your assets. The first step that is done when you test your property, plant, equipment is you perform what is referred to as a recoverability test. And in technical terms, it's just simply a comparison of your book value to the undiscounted expected future net cash flows for that asset. So if your book value is more than what the expectation of cash flows you have for that asset in the future, then we say that the asset itself is overstated, and we would refer to that as failing the recoverability test. So once you determine that it has failed the recoverability test, then you go to the second step to actually compute the loss itself. And that's the step 2 here, where you compute the loss that needs to be recognized on the books. And the loss is going to be based on the fair market value, not just the undiscounted cash flows. So where here for the test itself, we use undiscounted net cash flows. For the loss, we compare the book value to the fair market value. And the fair market value is nothing more than the discounted net cash flows. All right, so, well, here, let me just change this for consistency. All right, so let me give you an example so that you can see what I'm talking about. Assume that on December 31st of the year X2, we are examining an asset that has a historical cost of $9 million and it has accumulated depreciation of $1 million. So based on that, that means the asset on this particular date has a book value of $8 million. And we expect that there's still 4 years of useful life for this asset. And remember, we buy property, plant, and equipment. When we classify something as property, plant, equipment, these are these assets that we use for purposes of being able to generate revenues for the company. So because of that, we have an estimated life as to how long this project is going to generate cash flows for us. And in this case, it's 4 years. So as an example here, I say that the net cash flows, the undiscounted net cash flows, is $4.78 million. So if you compare that to the book value, then we would say that it fails the recoverability test, number 1, because the book value is greater than the undiscounted cash flows. In this case, I colored it in green. And then the discounted net cash flows, or sometimes referred to as the present value of those cash flows, or the fair market value, is $4,400,000. So just to give you an idea as to where these numbers are coming from, let me show you here what I did. So assume that for a particular company, from years 1 through year 4, this is what they expect to receive in terms of cash flows. So maybe they have expected inflows of $3,600,000. In other words, that's the generation of revenues from that particular asset. And for this purpose, you have to be careful because we're not necessarily talking about revenues per se, because revenues are based on the idea of earned, whether you've earned them or not necessarily whether you've collected the cash or not. And in this case, we're talking about just cash inflows. Okay, so this may correlate with your revenues, but sometimes you recognize revenues without necessarily having cash be received. So here is just the expectation of cash flows. So the expectation of cash flows is 3.6 million minus the expectation amount of outflows. So this company for the next 4 years thinks that they will receive roughly 1.2 million per year. And of course, this is based on a lot of assumptions, and things can change. But we do our best estimate at this point, 12/31/2, to come up with that estimate. So for purposes of you being able to see where the numbers are coming from right here, I do a timeline here. So the present value timeline at point 0, and by the way, this would be 12/31/2, just so that it parallels to what we have here. So 12/31/2 in this particular timeline would be point 0. And if I lay out these expected cash flows, net cash flows to be specific, I put them here over the next 4 years. And when I discount them, and the discount rate here I use is 3.4%, but obviously this discount rate can be based on the risk assessment of that project and other factors as well. But when I do the present value of this, I get roughly 4.4 million. It's off by $1 or so, but I made it be 4.4 million just so our numbers would be easy. But if you're curious, I did the present value. Here's the formula. The present value at 3.4% for 4 periods, and then these are the expected cash inflows. And when I do that, I get a little bit more than 4.4 million. That's why I do this. Don't worry about this $1.54. I just wanted the numbers to be easy for us. But when I get the present value, I get 4.4 million. And that's what this fair market value here is, this present value of all future cash flows. Now, where do I get the undiscounted net cash flows? That's just the summation of these 4 right here without doing any type of interest discount. So if I were to do a little summation there, I'll show you real quick. So the summation of these 4, let me block them here, is the 4.78 million that I'm talking about right here. Okay, so notice something here. This is a 2-step process, right? We perform the recoverability test, and then if it fails the recoverability test, then we have a loss to recognize. But notice how the recoverability test is based on a number that is perhaps more forgiving in terms of being able to meet the recoverability test. In other words, the undiscounted cash flows always will be higher than the discounted cash flows. So there might be a scenario where your fair market value, the discounted amount, is below the book value. There might be a scenario where that happens, but the undiscounted cash flows might be above the book value. And if that's the case, even though you technically have an overstated asset by some amount, since in that particular case that I'm describing, since it may not be the case with the undiscounted cash flows, then you would say that it meets the recoverability test, right? I hope you understood what I'm trying to say there. In other words, since this is a higher number, the undiscounted cash flows, it provides for a less strict test of the recoverability test. We could have done some, another test could be perform a fair market value test. And if you perform a fair market value test under some other asset types, that is the case, then it's a test that is a little bit stricter, and it would be compared to this. But for property, plant, and equipment, we don't compare, for the first test, we don't compare to the discounted cash flows. We compare to an undiscounted amount right here. So in this case, it actually, fails the recoverability test because $8 million is greater than 4.78, right? So that's step 1. And we say, okay, fails the recoverability test. We only use this number to test. And then the actual loss is going to be 8 million minus 4.4 million, as it is stated right here. So what I would have to do on 12/31 in this particular case is record that loss of 3.6 million. In other words, the difference between 8 million and 4.4. And I would recognize the loss for 3.6 million and then add that to accumulated depreciation. And I know that seems kind of weird, but one way to think about it is you've been depreciating this asset, and so far you've depreciated 1 million, but perhaps that depreciation approach you've been taking has not been sufficient. And because of that, we're going to add more depreciation. Now, mind you, that's not exactly true how I described it, but what I'm trying to get you to see is why we would credit accumulated depreciation. Recall that depreciation per se is not, depreciation per GAAP is not intended to be tied to fair market value. It's a systematic approach to get the cost of the asset to expense to the periods in which revenues are generated. You know, that's what depreciation is about. But sometimes depreciation is not enough to keep up with fair market value. And in this case, that's what's happening, right? So because of that, we're saying, okay, let's just record that property, plant, equipment at a lower amount because there is an impairment of that asset. Having done that, having taken this loss right here for the impairment, your book value now will be 4.4 million because you will have, in accumulated depreciation, you'll have 1 million plus 3.6. So that's 4.6. And if you take 9 million minus 4.6, that gives you 4.4. So that's the new book value. Your fair market value is now your new book value. Why is that important? Because next period, whatever period that may be, you're going to do depreciation again. And assuming that we're doing a straight line depreciation with no salvage value, just to keep it simple, then the next period's depreciation would be the 4.4 million new book value divided by 4 years, which is 1.1 per period. In this case, I'm doing a year. So you would debit expense, depreciation expense, and then you would credit the accumulated depreciation. Okay? And by the way, this testing of the impairment of the asset, in this case, property, plant, equipment, this is done continuously. This is done every period in which you are presenting financial information to outside parties. You don't want to send out those financial statements with overstated assets. What happens? So in this case, the value of that asset went down, we said, but what happens if the value, for some reason, later increases? Well, in line with conservatism under US GAAP, we cannot revalue it upward. Once we've taken that impairment, then we keep it in the books instead of rewriting it up. All right. So that's another angle of conservatism here. There is an exception, and that we may want to keep in mind. If for some reason you later intend to sell this asset, so in other words, you stop using it as property, plant, equipment. It's no longer an asset classified as property, plant, equipment, and now it's classified as intended to be sold. Well, when that happens, obviously you don't depreciate it anymore. Okay, you're not going to depreciate because you're no longer using it as property, plant, equipment. But if that is the case, even though we are not depreciating it, you may be able to write it up to recognize previous losses recognized. Because at that point, that asset that you're intending to sell, it will be treated kind of like inventory because we'll report it at the lower of cost or net realizable value. So if in reporting it at the lower of cost or NRV, this value is higher than the current book value, then we would be maybe able to recognize some of those previous losses that we took. But the recovery is limited up to those previous losses. So this is a rare exception. You know, it's one that may exist for you or not, but it's as long as it's being classified as property, plant, equipment, you cannot value it upward again. Once you've taken an impairment, you keep that impairment in place like this one here. This exception is going to be rare. Okay, so that concludes the video on impairments of property, plant, and equipment.